I think next year could be very strong in terms of earnings growth, but I think the consequence of good growth will be that authorities will start to take away the policy stimulus, and it's that really represents the big risk to equity markets next year.
Ronan, in terms of what we have been seeing, are there still a lot of concerns that actually instead of a recovery we're going to see a W-shaped recession?
Yeah, I think the medium-term outlook is still fairly challenging with high consumer debt levels in the Anglo-Saxon world and also very stretched government finances. And the risk is that when authorities start to raise interest rates and take away the fiscal stimulus, that the underlying trend in the economy is still very weak, and that the risk of a double dip perhaps in 2011 I think goes up post the tightening of fiscal and monetary policy. So that's the reason we think equity markets next year will have a tougher time.
So are we going to see a correction, Ronan, and what sectors still look to be attractive?
Yeah, I think near term we could see the market go higher. I think as we see continued improvement in growth, but as we get closer to the turning point in terms of fiscal and monetary policy, we would expect to see a weaker market, and we actually expect European equities to be down between now and the end of next year. I think the sectors that will do best in that environment will be the more defensive areas, particularly defences where you have some growth, like in consumer staples, for example. And we will be avoiding some of the more cyclical areas and also the financials.
Ronan, I wanted to get your sense of what the pharmaceuticals are doing, because, of course, it's been a surprisingly large outperformer, and you've been mentioning in your notes that actually it's been cutting a lot of costs. So is this something that you'd be looking to buy into 2010?
Yeah, I think pharmaceuticals potentially could be a surprisingly large outperformer next year. It's an ultra-defensive, very low beta, and many people view it as having gone ex-growth and view the medium-term outlook as challenging there because there are lots of major drugs coming off patent in the coming years. But we think the medium-term outlook may be improving because the industry is starting to diversify into new product areas, diversify into emerging markets. They are also cutting costs, like you mentioned, and the regulatory backdrop is improving as well. The FDA in the US is starting to approve more drugs, for example. So we think the prospects are pretty good, particularly if we're right that the market overall will go through a tougher time. So yes, I think it's a good candidate for outperformance next year.
Now, Ronan, talk to me also about energy, because if we look at your three largest overweight sectors, you have energy, materials, and staples.
Yeah, I think the case for oil or for energy is that it's firstly the sector is very cheap, particularly the big cap stocks are among the cheapest sectors in the market, with a decent dividend yield, low PE multiples. Typically, in this kind of a macro environment, energy does very well. When the yield curve is very steep, when you're in the 6 to 12 months before the Fed starts to hike rates, when leading indicators are strong but starting to peak out. In the past, when that was the case, oil did very, very well, oil companies. Whereas this year, they've lagged a little bit. So I think that's an opportunity. Also, as a house, we're quite bullish on the outlook for oil prices because we're strong believers in growth in emerging markets, and the supply situation remains very tight. So, we expect $85 oil next year, which would mean that consensus forecasts for oil earnings are still way too low.
Ronan, talk to me about the sector that actually you wouldn't touch with a barge pole.
Yeah, I think the ones to avoid heading into next year are firstly financials. Typically, financials underperform as you enter a tightening phase, which is where we think we are now in terms of monetary policy. We're close to the turning point in terms of monetary policy. And financials always underperform, and they're among the first sectors to start underperforming when that happens. Also, I think the risks are there in terms of tougher regulation, less leverage in the sector, and less credit growth in the broader economy, all of which should depress growth and profitability in the medium term as well.
Ronan, great to speak to you. Ronan Carr there. Have a great day.